So one of the things that I try to be really sensitive to is, some of you have money, so the thought of buying 100 shares of this or that, no big deal. Others of you are just getting started. And maybe what attracted you to options was just, the notion that you don't need a lot of money to do it. And maybe you're just getting started with this. So I'm always mindful of workarounds. What do I do with, because I'm teaching this to family, friends, and some of them, you know, don't have a lot of money. Of course, they all expect I'll just drop 10 grand on them to open an account, which I've done, but I'm not doing that for you. Sorry. So, what do you do if you don't have the money to buy the shares? We're going to substitute longer term call options for the stock. So there is a term called a LEAP, long-term equity anticipation, blah, blah, blah. Forget about all that. Just look at these LEAPs as longer-term call options that are going to replace the need to own the stock when it comes to things like covered calls. Do you remember when yesterday, and as a review today, I said, if you're going to short a call, you want to either own the stock, remember that, or what? A call option you could use to buy the stock. I was setting that up for this moment. So let's kind of talk about how do we do this and what is the purpose? And I'll kind of run you from A to Z. We'll take one of these covered calls, and instead of buying the stock, we're going to buy a LEAP. So deep in the money. Deep in the money, what does that mean? Delta 80. It's just longer term Delta 80 options. So identify a mildly bullish stock. We got a whole bunch of them to pick from, right? We're going to buy a long-term call option. Instead of the stock, it'll serve the same purpose. Delta 80, nothing new there. If you own a long-term call option, if you ever get to the point where you're looking at a chart and you're like, or it's got a bad earnings announcement or anything else, just close it out. How do you close it out? Go into your brokerage account, find the LEAP, hit close next to it, right? And sell it. No different than making a decision to sell a stock that you no longer want to own. Now, this is what makes it kind of exciting. Consider selling shorter term calls against the longer term call. Some of you are like, okay, now you've lost me. No problem. Let's do this. I'm going to pick one of our covered call candidates. Let's do Intel, and I'm going to come back to Intel for a spread trade. So Intel's that's too cheap. How about Coca-Cola? Since we've looked at that one before. So Coke is trading for $71 a share. So maybe, and it's a great covered call, but maybe you don't have $7,100 to buy 100 shares of the stock. So what else could you do? We're going to come into options. And generally on these, I'll go out something north of 6 months. Like around 9 months is kind of a good time horizon. So let's do 200 and there's no activity for 237. Let's go out 272 days. Okay. And we're going to do Delta 80. There's a Delta 80 exactly. So if I did one contract. What is that going to cost? Between $13 and $14 a share. So now, all of a sudden, I can do this trade for $1,300. Big difference, right? 1,300 versus 7,100. And you can set it up so that you could simultaneously buy this call, and then let's just sell a call against it. Sell to open. Let's go out 6 days. Strike price 72. There you go. So now what'll happen is what we collect shorting this call helps to pay for the longer term call. Go to the midpoint. There you go. So it's going to cost $13.29 per share. So on 100 shares, $1,329 instead of $7,100. And one of the other things I like to do is I'm going to divide this number by this number, the price that I'm going to pay. Basically, what I'm going to ask myself, okay, if I'm getting 35 cents for 6 days, how long is it going to take to pay off this call option that I bought? Kind of like with a covered call, except you're paying off your stock. Here, we're paying off the call option. So if I pay about $13.50 and I divide that by 35 cents, multiply that by 6 days. Yeah. So 13.50 divided by 35. So in 231 days, I'm going to have recouped 100% of what I paid for this call option. So then I own this for free for another 40 days. During that 40 days, I continue to collect whatever I can get selling calls against it. And then how much is this leap worth at expiration? It's worth whatever Coke is selling for minus my strike price. I have the right to buy it for 60. So let's say that 272 days from now, Coke's at 80. That seems reasonable. I have the right to buy it for 60. How much is that leap worth? $20 a share. So on top of the income that I'm going to collect from selling calls against this leap every single week to recoup ultimately my investment over time, plus what I'm going to get for that last 40 days, on top of that, I'm going to get whatever the value of the leap is, which is the difference between the then price of the stock and what? And the strike price. That's my bonus. That's pretty exciting. What is that as a rate of return on a weekly basis? If I take 0.35, divide it by 1350, I'm bringing in basically 2.5% every 6 days. There are people that don't make 2.5% in a year in a bank account. We're doing it every 6 days. Why? Because we know something the average person doesn't know. What did I say to you yesterday? If you want to have the things the average person will never have, you need to know what the average person doesn't know. There's a great example. I bet I don't have one of you that's buying leaps and selling calls against it unless you've been in one of my classes before, because it's just not something that is typically taught, because you got to think a little bit outside the box in order to do it. Now, the question might be, and a most typical question, well, what happens if the stock goes up and I get called out of the stock? I don't own the stock. Well, then you just convert the leap into the stock. That's what the leap does. Gives you the right to buy that stock at that price, and you deliver the stock. So you got all your bases covered. So generally on these leaps where I'm selling calls against them, my intent is to just hang on to that leap all the way through. Now, what if that underlying stock, what if Coca-Cola just went into the crapper? Then I'd just close out the trade. I'd sell the leap and I'd buy back the short call, and then I'd go find something else and start all over. But that's why you want to begin with fundamentally strong companies. All right, take a couple of questions on this strategy, and then I'll give you a break here. Pretty fun segment, right? Date is right. Yeah. Sorry, so complicated, don't understand. Okay. First of all, I appreciate you doing that. So let me just restate a couple of things. Number one, did you understand the covered calls? And if you go, yeah, I understood the covered calls, take out the stock and replace it with a long-term call option, and everything else is the same. That's it. We're simply replacing the stock with something that's lower cost. Don't you to buy back the stock you sold at no. Sharon, the short answer is no. I don't understand why that would even be a question. Unless I misunderstood what you're really trying to ask me. Can the brokerage automatically sell the leap if called out? Some do that, Daniel. That's a really good question. So check with your firm. Some, if you get called out, they will automatically take care of the leap and the whole transaction for you. Will this strategy be effective on a stock that is significantly in the red? No. Is a covered call effective on a stock that's significantly in the red? No. Everything is the same as a covered call. Do all optionable stocks have this leap? Yes. Yep. Do you have to show cash in the account to exercise the leap? No. You got paid, right? Remember, the stock got called away from you. So you've already got that money in your account. There's nothing for you to need to show. It is already there. All right, let me show you one more thing before we go to break. And I want to show you this hedging